Okay, so we're on to part 5. We've covered quite a lot in the first 4 videos now. So we're on to part 5, how to be a profitable trader. And on this video, I said we were going to look at daily bias, looking at the daily candle. What else did I say? So our higher time frame bias. And yeah, I think that's about it. I've got a few more things definitely on the list we're going to talk about. And then we're going to go into some back testing as well, how to back test, what you want to do when you're back testing, and stuff like that. Okay. There's a few more things I need to go through as well. It's daily bias, but this is quite an important one. And we'll go through another PG array here. So in the last video, which I found hard to spot, was how the bodies here, for example, overlapping the high of this candle, showing this on the daily chart now. The high of this candle is high. The high of the body of this candle is higher than the body of this candle. So if I was to look at a PG array, I'd look at this one. It's the lowest PG array on the chart. So what you tend to do is you look at areas where price can refer back to on the daily chart. So we're extremely bullish. Price has been moving up for a long time. So if I zoom out, see how we're on a really bullish trend. So we like to expect higher prices when that happens. So when I'm looking for next week, or prior to Friday, which is the day we've been looking at throughout the series, we're looking at the daily chart and we're highlighting PD arrays. So aside from this, if it didn't reach here, which it didn't, say it wicked down, it could have gone up from here. But where else on this chart? We haven't talked about this in terms of PD array, so I'll introduce it now. So you have what you call a big long wick here, which can be used as a discount array. So I'd call this a discount wick. So looking at that, you want to draw it on like this. And what I will do, there's a tool called a Fibonacci, which is based on new numbers. Don't need to go too much into it, but we just use it here. So it says Fib retracement. Click on it. Go from the high down to the low. Just need to get this box directly on. You can go all the way down to 8, which we will try and do as well. If you double click on it, look at all the boxes I've got clicked. What else? Okay, so this is 8 off of this. So we're expecting these 8s to support price as we go higher for the daily candle. So if we're opening here, and we're looking at the chart, so we know that opens at what? So if you can remember from the second or third video, we got it at 6 p.m. close at 5 p.m. So if we're looking at the chart at 6 or 7, we're thinking, well, if price wants to seek a discount, how low can it go? Well, it could go all the way down to here. But we're looking to see if we can see a reaction at this level around the middle, which is key. Consequent encroachment, that seems to be like the turning point. If price can go all the way down here, we could expect lower, okay? And down to what? This next array, and see if we can react from there. But if you are bullish on the daily chart, my bias would have been bullish on this day. And the market says 1 prior to this day was all-time highs. So we're seeing if we can get through all-time highs. Okay, that makes sense so far. So remember what this is. It's the 8th levels of this discount wick. You could also use this volume imbalance or the next day. It could refer back to this volume balance. That's a premium array. So we're seeing at a discount array. So we're seeing how price can refer at this level. Okay. So here it trades down through that gap, and comes down to this level, which is an 8th level of the discount wick. But you want to see it as it trades to the 5th support price, and it trades to the 6.2 support price, and so on, and it will refer back to these levels throughout the day. So let's go to the 5-minute chart, back to the day we've been looking at the whole time. So 1, 2, 3, 4. Right, that's the top. 1, 2, 3, 4. Consequent encroachment just touches down to that 8th level, and then what it refers to, the consequent encroachment goes higher. So what an 8th level reverses to an 8th level, back up to an 8th level. Okay. So we're looking at price like that, and we're looking for it to refer price at and have that daily bias in terms of that, and that's without looking at all our other PDOs. It just kind of gives us a bit more X-ray vision to where we're going. So if we go back to the daily, and we see that our reaction at around consequent encroachment of that wick, is likely to assume that we've reached the low of the day. The 1-minute chart. And again, you're pondering this in macro time. So here, for example, 3 o'clock between 2:50 and 3:10, our bodies fail to get below this 8th level. Yeah. At here, this level, at our macro, we trade above the 8th level, so it's likely to assume we're at least going to this 8th level. What's 8th level? Price trades down. Look how close it is. Below these lows, pre-market lows, to what? An 8th level. Move here. 350 level. Here we're at an 8th level. 250, 310. Going down to what? 8th level 1, 8th level 2. Oh, sorry, 8th level 1, 8th level 2, 8th level 3. So we're moving between this throughout the day. We're bullish, and it's assumed price is going to go higher. We're reacting at the consequent encroachment in deciding what way we're going to go for the day, and then it decides to go higher for the day. So we can assume when we get into these sessions, our bias is what? Bullish. Like if you took this trade in line with your bias at 3:30, or if you wanted to wait till 4 o'clock, 3:50 till 4 o'clock, entering off this fair value gap that forms at what time? 3:49. Then it refers to it in the macro time to trade up. Okay. Again, if you entered here, you could just target this high and get out here. If you want to target higher, you can. So that's how you use daily bias. The discount wick, but it depends. You need to know, this is what you need to know about the PD arrays, because when you go to the daily, let's show you off another example of using the daily bias. We go back to, so say you have a fair value gap. I don't know if I've covered this yet, I can't quite remember. If you have a fair value gap where you assume that's fair, you've you've got to incorporate the volume imbalance with the fair value gap. So you draw it all the way down like that. Okay. And then we go on to replay mode, just so I know where we are in price. Just go to here. We'll see how price when it trades down to it reacts. Right, let me just check which day we're on. I've got a bit lost in my mind. So this is Thursday the 28th of May. Yeah, perfect. Interesting, yeah? So we're reacting off an 8th level, which would be the upper quadrant. So if sometimes when you have the 8th levels, people think it's a bit harder to look at. So sometimes I just go for just the quadrants. So if you choose the quadrant levels, it tends to be better. If you want more to your arsenal, use the 8th levels. If you're finding the 8th is too difficult, use the quadrants on the Fibonacci. So 0. So when you set it, you've got 1, 0.5, 0, 0.75, 0.25 of that value gap. We trade to the upper quadrant, and look, we react and trade higher. We trade back down to the high of the quadrant level, and again, we're bullish on the daily chart, so we're expecting reactions higher off this. Okay, and look, trade high for the day. Okay. So this video is about how you use that Fibonacci and high time frame. Let me just see how long this video has been. Oh, so we're at 12 minutes. Shall we go for a bit longer? Yeah, go on. What do you want to know next? Well, the key to know next is what optimal trade entry looks like using the Fibonacci tool. For this, you don't even need to know PD arrays. So this model is beautiful for a beginner, which is why I've had it in now. So I'll leave these on here. Just be mindful, this is if you go back, just to remind you one more time, the quadrant levels of this fair value gap, you have to incorporate the volume imbalance. Let's make sure that's precise. Sorry. And the bodies failed to breach it. So again, now let's talk about optimal trade entry, and premium and discount. So if you look at every swing high to a swing low, so the lowest point on the graph to the highest point. So say I'm looking at this graph now of the New York Open, we're expecting higher prices for the day, yeah. So it's unlikely to assume we're going to come back down past this low, yeah? So we've done that reaction, we've reacted here again. But this is what's happening, is that people here think, oh, it's going to go lower, yeah? But it's not. We've got this high and this high, which are what? Relative equal. That dog's going mad. Renosh! Let's see what's outside. Give me 1 second. Shut the door. No bomb. Come in. Sorry, the dogs have just come in and disturbed my video, but I'm doing this one shot, everything's one shot, so I ain't doing this again. So it is what it is. Make do there. So we're expecting high prices, so it's trapping short sellers here. Well, how low can we expect it to come? We've already swept this low, so these aren't relative equal load. This is a strong reaction. So during this swing, so highest, if you go to lowest point, highest point on the graph, you can use optimal trade entry to get in at this specific level. So what that means is, when you have, if for example this is a high on the chart, this is the lower chart, anything in this lower half is called discount, anything in this upper half is called premium. So you want to buy at discount, sell at premium, buy back at discount. That makes sense. So a deep premium would be this lower half, this upper half, and a deep discount would be this lower half. That makes sense. Very basic in terms of that. So you take the lowest point on the graph and the highest point of the graph there, and when you click, I'll unclick all these quadrant levels because we've got the basics of premium and discount. Now you want to leave on the one thing, so you've got 3 zones now: the 0.79, 0.62, and optimal trade entry is this one, 0.709. These are key levels within the fib. And I've got these the wrong way around, so you just got to do it like this. Lowest point. It's the highest point. So that's how much we can expect retracement. We're bullish. So optimal trade entry. You think, oh, you're pulling my leg here. You're thinking, no way could it be that precise. Honestly, it's algorithmic and it happens all the time. So here, we'll find some other examples in a second. 0.709, optimal trade entry. Fails to reach 0.79. Yeah? And then we would just react off it and go higher for the whole day. Yeah? This is a 5-minute chart, so it doesn't look as much as what we did in the 1 minute. I'll show you on the 1. Sorry, that's the 2. 1. Beautiful. Off the 0.709 to go higher for the day. And you could have caught that as a move if you got this correct. Crazy. You can use every swing high and every swing low as an example. So let me just how am I doing? So say you're late in the day and you're at this time here, you're thinking, oh god, I've missed the optimal trade entry. Just look for the next one. So you've got swing low, swing high, comes down 0.62 within optimal trade entry zone, which is these 3 lines here. That's why you've got them on the chart. So you've got 0.62, 0.79, and it shouldn't reach further past 0.79. Otherwise, that wouldn't be an optimal trade entry, and you're most likely wrong. Okay. See if I can. It's quite hard because this one just trades high for the day. But I'm looking for prime example. Let's go back, and this one just trades a little up. I just love seeing it in action. Like, here we go. Let me see if I can extend through. So if we're bearish in this session, for example, and you miss all this, well, how high can it come back up? You've got the highest point, the lowest point comes back up to what? Above these highs. To what? Optimal trade entry. What time's that? 8:50, not 8:50. 9 within our kill zone. So you could enter just off the basis of that and go lower. But if you know where it's going, below what? Relative equal lows. That makes sense. You just need to have that confidence to enter if price is going up. Yeah, and that's what you will develop through time and through back testing. Okay, what time are we at? 20 minutes. So I think that'll do for this video. I'll try and show a couple more examples of this. I think that's pretty much where we're at. Let's just see. Maybe I can find one more just to give you the confidence to take trades in it. So here we go again. We're bullish on the day. Or you might want to use this lower here, lower than that one. What time is this? 11:50. Macro time. 12:10. The lowest point, the highest point comes down, reacts to go higher. Crazy, absolutely madness how you could not think the markets are algorithmic after watching this series. So yeah, I think that'll do. It blows my mind still looking at it, to be honest with you. So yeah, we will come back to more things on the next video. So let's have a look what I've got on my little notepad for everyone. We'll talk about midnight price in the next video, and then we'll talk about new day opening gaps, new week opening gaps, and bundles of more things we've got in this series that I haven't yet released. So yeah, thanks for listening, and again, peace out. Look for these examples in your chart, and yeah, until next time, goodbye.